Dun, dun, dun. Green is good. Thank you. Okay, guys.
Access to this webinar
Whoa,
is for
that was
educational and
fast.
informational purposes only. Consult a licensed broker or registered investment
Wasn't ready.
advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither philstockwell.com, PSW, nor its affiliates, nor any of their respective officers, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website www.optionsclearing.com to read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you the risks and potential rewards of options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any benefit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously and we will not distribute or sell your information to anyone.
All righty. We're up like 1,000 points. Very nice. Very exciting. Looks like we picked the right time to go long, right? On Monday. What's today? Wednesday. Today's Wednesday. So we nailed it at the moment, but I'm still skeptical. We were discussing the levels and such. It's real easy. The 5% rule. One of the key things of the 5% rule is you look for 20% retrace of a move. So when you have a move from 3,400 to 2,200, that's 1,200 points. And so technically 20% of 1,200 would be 240. So 2440, or we'll call it 2450 to round it off, but 2450 would be the weak bounce line. And you can see here, maybe if we do an hourly, it'll be more obvious. So you can see 2450 right here. You see how that's kind of a little consolidation zone there. That's the weak bounce line. But that's good action. We consolidate under the weak bounce line, bounce around it a little bit, and then finally break over it. The next one after 2450 is going to be 250 more is 2700. So the next major bounce is the strong bounce line is 27, and you can see how that the strong bounce line is correct, because since it calculates 2700, you would expect to see resistance there even before it was made, and you can, because we held 2700, then we failed it and dropped harshly, came back and tested 2700, failed it, and now onto the weak bounce line. I mean, sorry, onto the well, first to fail around the weak bounce line, then to go all the way down. But in other words, you could have almost predicted where the bottom would be by observing where we were having support issues over here. And that's the beauty of the 5% rules. It really does. It's not like charting, which is bullshit, because charting, you have to look. A chart only really works for people after they see it. They see it and they draw these lines and make trends and whatever. But the 5% rule, you can pretty much calculate it. You can say, well, if we're going to fall this much, then we're going to bounce this much. So, once you go through certain levels, let's say, for example, well, we're at 3,400. So we say, well, we're at 3,400 and times 0.6 is 2040. So we already know what a 40% drop is going to look like. What's a 20% drop going to look like? 3,400 times 0.8, 2720, which happens to be the weak bounce line. I mean, the strong bounce line. But so once you fail 2720, once you fail the 20% drop, you know that you're heading to a 40% drop. You know that that's your next major support is going to be 40%. These rules hold up at all levels, and especially because you can go back and see what happened last time, and you could see that 27 did not provide 27 was some support, and we came back to it, but realistically, that's going to be a point of contention. This is what we call very important thing about the 5% rule, and this is why a lot of people who are, well, what I call recipe people. My daughter Jackie's a recipe person. Like she's really good baker because she follows recipes, but she's a terrible cook because she follows recipes, because she doesn't improvise. She does exactly what things say. And that works sometimes and it doesn't work sometimes. And you know, you have to, if you're a really good cook, you improvise and you make stuff up and you throw things in. And I'm a big improviser, of course. I'm an anti-recipe person. I make brownies, that's about it. It's like my only baking tool. I just don't have the patience. I like to mess around with things. It's no fun for me if I have to like just follow a recipe. It's like I may as well just buy it in the store. But a lot of traders are also recipe people. They want to say, how exactly does this work? When is the exact point at which it turns? What is this and that? You never know for sure. You got to be able to improvise. And one of the big improvisations that's required in the 5% rule is you have to learn to ignore spikes. And a spike being something that blows through the trend but isn't part of the trend. So in other words, that's a spike, that's a spike. Okay, clearly this line, whatever that line is, 26, I guess, yeah, I don't know if it's 26 or 26, I think. No, yeah. So the 2600 line clearly is the real line of support. This becomes then a spike. So when you say, okay, this spike is bullshit and this spike is bullshit, these make sense, that makes sense, then you say, well, this spike, even though it lasted for a month, was still a spike. It's something you ignore. And frankly, I got a feeling that we're going to end up ignoring this too. Okay, even though this is traumatic, it's still going to be a spike that gets thrown out, and you're still going to say we have very solid support at the 2600 line on the S&P. Now, I don't know what our big chart line is on the S&P. I think we're still using 2850. Let's take a look. I think our primary support is 2850 on the S&P. No, oh no, it's 2600. How weird. So that's now see, that's the funny thing about the 5% rule. It's smarter than I am. So, you know, based on some serious calculations we did last year and several years ago, frankly, these are the oldest support lines. We determined that 2600 was the fair value for the S&P. How do we determine that? We take the top 20 components in the S&P and we decide whether or not they're fairly valued, because the top 20 components in the S&P are basically 80% of the index's real value. And the same with the Dow. On the Dow, we take all 30 components. There's no reason to take the top 20 when there's only 30 components. We take every single Dow component and we decide what they're worth. And I did that with the NASDAQ too. We took like the top 20 of the NASDAQ and figured out what the NASDAQ is worth. So that's how we determine the real value of an index. That plus, of course, where the chart, you know, where the 5% lines are and so on and so forth. But in this case, we came up with 2600 on the S&P. That is the correct fair value of the index. And then oddly enough, even though we wrote this, God knows, I couldn't even tell you when we did this, but I mean, it must be at least 2-3 years ago that we came up with that number for being the correct value. And by the way, when we say correct, we mean the forward, the 1 to 2 year range of the S&P that we expect it to be within 20% of that number. Could be above 20%, could be below 20%, but that's what we expect. So 2600 is our fair value, and usually for the big chart, we are within 10% of where we expect to be. It's not, this is an unusual market. We usually are in this range for almost everything. So 26 was the correct range for the S&P. And here you can see, where was that? Oh no, it was the other one. And here you can see on a 2-year chart, here's why 26 is the correct range. It's, I wish you could make a line or something. It's right here, going across, throw out that spike, correct. See how it is? 26, no problem. That is the correct fair line. We can be above it or we could be below it, and you shouldn't be alarmed to be 10% below or 10% above. If you're over 10% above, so 26 and then another 260, right? So that's going to be 2860 is 10% above right up here. and 10% below is 350, I guess. So about here, 350. And look what happened here. We exactly hit 350, 10% below. So, you know, this is pretty much a spike we're going to ignore below. And this will end up being a spike that we ignore below. We're probably going to settle in around this range up to where I said, what did I say, 2750 should be the bounce line over here. Or 2700 is going to be the bounce line. So 2700 is the bounce line. That still doesn't negate 26. It just means we're moving into the range above 26, and then we'll drift around there for a while, probably between 26 and 3000 range, and as low as 22. But we already went to 22. It's no big deal. But the problem is, though, if your portfolio is geared up for this, and you're expecting to get back to here, that's probably not going to happen. This never should have happened. We never should have been this high. Everything above 3,000 was a mistake. We got out. We cashed in our portfolios in September right here, before this drop, actually. So we cashed out our portfolios before the drop in September. It went down like we expected it to. Then it rocketed back up. And we just sat there with our hands crossed and didn't really play. We did, though. We started some little portfolios in October, because just in case it kept going up forever, we didn't want to completely miss the rally. But what we thought would happen finally did happen, and the market really did collapse, and we have a major correction now. But the major correction is not that big of a deal, unless you can't react to it, unless you overinvest, unless you can't adjust, unless you don't keep any money on the sidelines. Then it's a big deal. If you're fully invested at the top of a market, you're foolish. You can't do that. You should never do that. You know, we've always got 50% firepower on the sidelines, and frankly, this market tested it. I mean, we had to put more money in. Well, we knew that, though, with the dividend portfolio, because we filled it up. And we said if the market, you know, we said we'd have to put more money in if the market drops, because we used up all the money to make the dividend portfolio. The butterfly portfolio, just to have more flexibility to take advantage of the drop, we wanted to add more money to that. The long and short-term portfolio were fine. I think the other portfolios were fine too. They didn't really need money, but they also went down considerably. But now they're massively improved, because they mostly went down because they didn't go down because the positions were so terrible. They went down because the VIX was so high, and we sell a lot of premium in that strategy. That's what was killing us. So now that the VIX has come down considerably, we don't have that problem, but we do have a problem that we put a lot of money into our portfolio. So we're going to have to seriously think about, even early on, taking profits off the table. But one thing at a time. Let's see if anybody has any questions. Nobody has any questions. That is fantastic. Okay. So where are we on the dying thing? Wow. Is that all we had last week? Wow. This is kind of mind-blowing. Okay, so here we are. This is 318. This is 226. We had 81,000. And then we had 211,000. We had 2,700 deaths. We had 8,000 deaths. We had 83,000 recoveries. We had 30,000 recoveries. So now we're not going to need this anymore. So I'm going to take that and I'm going to refresh it, because now this one's going to be a month old. This is March 4th. Wow. Watch this. Keep in mind that this was last week, 211. Oh, it's not working. It was saved. Look at that. That's a week. 325. We looked at this thing on 318, and it was less than half a week ago. 441. 19,000 dead, up from 8,000 dead. 100% increase in deaths, 100% increase in cases. Last week, 83,000 recovered. This week, 111,000 recovered. That is not a 100% increase in recoveries. 100% increase in cases, not a 100% increase in recoveries. That means getting worse. There is no other conclusion other than getting worse. Okay, we were, I don't want to say fooled, but we were, looking at China and saying, oh, China, oh, 80,000, and still 80,000 this whole time, 80,000 for a month was really about 80,000. Look, see the whole world, 90,000. So here's China. They hit 80,000 here, first week of February, and they were the only people in the world, very few cases outside of the world. This is when Trump was saying, we only have 15 cases in America, it'll be over tomorrow, blah, blah, blah. So then China, basically for February, all the way until here, the whole month of February, China still had 80,000 basically. So everybody's like, oh, that thing's over, no problem. But then the rest of the world started ramping up, and those 15 cases became 55,000 cases in America. The cases that we didn't notice in Italy became 70,000 in Italy. Spain, 47,000 cases, and now Spain leads the world in deaths. No, they don't. Italy does. I thought Spain led the world in deaths. Italy leads the world in deaths, 6,820. But oh, I know, Spain just passed China. That's what it was today. Spain now has more dead people than China. Look at Iran, 2,000 dead in Iran, 1,000 dead in France, 400 dead in England, 192 in New York City. They don't show the U.S. as one piece, or we'd be freaking out because we're probably close to 1,000. They don't show the U.S. as one place, and that's obviously pressure from somebody to make it look like the U.S. isn't so terrible. Here's China, right? There's China. That's their confirmed cases, but look at active cases. See that? That's way freaking better. Now look at the US. There's confirmed cases, there's active cases. It's the same map. And Europe too. Confirmed and active are the same. Things are not getting better unless active is smaller than confirmed. I mean, this is not complicated. And this is the thing. Why do you listen to anybody on TV or Trump or anybody telling you how they think the virus is going when there are numbers? Numbers tell you how the virus is going. If people tell you it's cold outside, you understand that everyone has an opinion on what cold is, and it might not be your opinion. So you look at the temperature, or maybe you stick your head out the window before you go out because you want to know if it's really cold outside, despite what people tell you. This is the same thing. There is a fact. You can find out the fact very easily. These are the facts. Okay? Twice as many cases as last week. Twice as many deaths as last week. 30–40% more recoveries than last week. So people are dying faster than they're recovering. There are new cases faster than people are recovering. Those are the facts. So we are still getting worse. We will know when we're not getting worse. We will know this it'll be very obvious when things are not getting worse anymore. This is not that time. So when Trump tells you we're going to get back to normal by Easter, that's completely bullshit. It's not even close to possible. It took China a month after the virus peaked for them to actually start even considering normalizing. They didn't normalize really. They're only normalizing the last week. So they went 6 weeks after the virus stopped spreading rampantly. We're not even at the stop spreading rampantly part. And to call an early dismissal and let people run outside and play when they can reintroduce the virus to each other is beyond idiocy. I mean, at some point you really do have to remove the guy from office if this is what he's doing. He's dangerous to America. He really is. And politics aside, I mean, for God's sake, it's like you got to do this the right way. You got to listen to the doctors. We have no cure. It's a virus. That's a fact. We have no cure. That's a fact. We have no vaccine to prevent it. That's a fact. Therefore, if you come in contact with a person who's got the virus, they can transmit it to you. So the only thing we can do is not come in contact with people. Well, if we had preventive things, it apparently is mostly transmitted through the air. If we all had face masks and gloves, we could probably go outside and have a good time, like in China, which they do. I mean, you know, in China, you think it's social distancing. They're not social distancing. They all have face masks. The face masks are extremely, extremely effective in preventing the spread of the disease. But we don't have face masks. We have no supplies. So that's where social distancing comes in. What do you do if you don't have face masks? Well, you stay away from each other in that case. But you can't force it. The only way we're going to get back out in Easter, and even if you do, it's still stupid to go to have everyone to go sit next to each other in a church or whatever. But the only way we're going back outside by Easter, which is April 12th, which is only 3 weeks from now, is if we have a huge amount of face masks, and that everybody has them, and not just everybody has one. Everybody needs to have one that they throw away every time they go out. So that's going to take a lot of work to get to that level where we're safe. And even then, you still shouldn't let infected people walk around, which means everybody needs to be temperature checked before they walk into a mall or before they walk into a store to go shopping and whatever. And it's not hard. It's not hard to have somebody stand there with one of those little ear thermometers or something like that and just go bip and check you when you walk in the door. Bip, check, done. You've seen people do those. It takes 2 seconds to check your temperature. And they got ones that can check it through your eye. They got different ways of doing it. Bottom line is though, you can easily check someone's temperature and make sure they're okay to go in the store. Doesn't prove anything. It doesn't eliminate everybody. You can't always tell if people have symptoms, but it's something. It would eliminate 75% of the people who are dangerous. That right there cuts your exposure down by 75%. That's what this is all about, right? And it's all simple. It's all just math and numbers and science. But we have a government that doesn't believe in any of that stuff. But as investors, that's what we need to focus on. Now, it brings me back to my other topic though. Why did we get bullish on Monday? And not just Monday, I mean last week we started setting up bullish. What was it about this last week that made me say this is enough? Okay, well, first of all, we know 2600 is our must hold line. So from that, we calculate the damage. All right. China's GDP is off about 20% in the first quarter, and maybe it'll be up 20% again in the next quarter. But it's not minus 20%. I mean, I'm sorry, it is minus 20%. It's 20% lower than it was. But usually they have 8% growth. So, you know, so for them, that's not a terrible thing. So it's really 10% lower, 12% lower than it was. So let's assume in the US we have 20% lower GDP growth. Let's assume we have 30% lower GDP growth. Our quarterly GDP is 1.5 trillion dollars, right? Because 1.5 times 12 is $18 trillion GDP. So our monthly GDP is $1.5 trillion. So if we lose 30% of our GDP, and that's a lot to lose. I mean, that just means hardly anything is getting done. And meanwhile, while I'm talking to you, you're on the internet, you're using the internet, you're watching ads, you've got a TV, you're doing a lot of the same stuff you do in your daily life, right? In fact, what do we do? What do we do every week? We do these webinars. Are we not doing the webinar? We're doing the webinar. You know, you're eating food. I've got my normal iced tea in my hand. It didn't stop. I just got a couple of cases from Amazon. You know, I'm always drinking my iced green teas. I'm still paying for my phone. I'm still paying for my internet. All this stuff. It's like I still pay my rent, even though I guess you don't have to. My mom didn't have to pay rent. My mom called. They let her skip her rent, her mortgage, not her rent, her mortgage. That was kind of cool. She heard you can do it, so she called her bank, and they were like, "Yeah, sure." I was like, "Wow, that's cool." So yeah, make sure if you have if you have loved ones and stuff, tell them that let them know these programs are available and they work. The banks have already been told that if any senior citizen basically calls them and says, "Can I skip my mortgage this month?" They're like, "Yeah." So a phone call, literally no paperwork, nothing. They just said, "Sure, let me fix that for you." And my mom skipped her mortgage. So that was kind of weird, actually, I thought. So things aren't that different. And obviously for some people, they're devastatingly different. Anybody who owns a restaurant, works in a restaurant, most food things, retail stores now, of course, nobody's shopping, nobody's going out. Devastating for that part of the economy, for sure. Okay, retail sales for the country, but that's the part of the country that's down. Retail sales are $6 trillion a year. But again, I've got my tea. That's retail sales. So it's not all gone, but let's say it's half gone. But that's still only if let's say it's 6 trillion a year, and that would be 500 billion a month. And let's say that's half gone. Well, that's 250 billion a month in lost retail sales. Obviously people are buying toilet paper and so on and so forth. So stuff is getting bought, just not the same things. And maybe I would say probably any kind of mall-y stuff like clothes and things like that are probably not being sold right now. But you know what? Give it a few months and they'll start getting sold because people aren't going to never buy clothes again. They're just not buying them right now. After a while, they'll start ordering at home. But so there's 250 billion of the damage, but I'm saying $500 billion damage. I'm already giving you that. So meanwhile, there's $500 billion being lost in the economy and the Fed and the government's replacing it with $2 trillion, and it's only been a month, we're kind of ahead of the game. So on that basis, starting last week, we started buying some stuff. And especially towards the end of the day on Friday when the market turned down, I was like, screw this. And I thought I'd put out the long-term portfolio thing. So just roll everything for sure. Oh, I'm sorry. This was Thursday. No, I'm sorry. Oh, I know what happened. We did our portfolios Friday afternoon. We did a lot of roll downs, but I didn't have time for the LTP plus because of this. I wanted to wait and see what happened. But then Monday, when this thing fell apart and we were way the frick down here, that's when I got super aggressive with the long term and the butterfly portfolio because you don't turn this down. We didn't expect to get that low. And if we got lower, we know how to hedge it and we know what to do in case it got lower. But I strongly felt that this was going to hold up because we were really down because of a fear that there was going to be no stimulus, which wasn't the case. It was only being held up by the normal stupidity. Like the way TARP was, where right when we didn't pass TARP the first time, the markets completely freaked out. They still passed TARP, they just didn't do it that day. But what was my headline on Monday? Yeah. So Monday, Congress fails to deliver the good news. And that's why we were going down and down and down, because people freaked out that they didn't agree. But it wasn't like they weren't agreeing. Here's what happened in the morning. It wasn't like they didn't agree that they were going to give a stimulus at all. They weren't agreeing on the details of how they were going to give a stimulus. And so now, as we get closer and closer to a decision being made, we're flying back up. Now, again, I don't expect to go back to 29 or 3,000 or whatever. I don't expect that. I expect to go back to about 26. I expect it to be uncertain for a while with the virus. But this is very comfortable. But the problem is, if we hadn't adjusted our portfolios and we needed to get back to 3,000 plus in order to get even, that would have been a terrible idea, right? That's why we rolled everything down. That's why that's why yesterday, as we were crashing out, oh, not yesterday, was it Monday? So confused. No, it wasn't yesterday, silly me. It was Monday, 23rd. So Monday, while we were crashing, And you know, I'm sorry, but it's I know it's hard to do this because I did it the same thing in 2009 when the market collapsed. In fact, but I was talking about this last week. I was telling you guys this is what happens. It's here. In fact, the last webinar we were talking about it. There, that's me, 2008, 9, March 2009. Oh, and it's March again. Isn't that weird? So talk about an anniversary. So I'm on TV. The market was down 300 points, which we used to consider a lot back then, and and I'm sitting there on TV saying buy this, buy that, buy that. I just kept looking at the tickers going across the screen and saying, oh, look at that. Oh my God, look at that one. That's what I was doing on the TV show. I was like, oh my God. I just kept every time I was done explaining why I liked something, because with each one of these things, I would give an explanation of why I thought it was a good play. And I was saying they were going like that. And it got to the point where I just started like taking out any blue chip. I was like, GE, are you freaking kidding me? Bank America, Disney, Amazon, Target, Hovnavian. You know, it's just like you know, when you see a blue chip go on sale like that, that's what you want to buy. And you guys, a lot of you guys keep asking about weird stocks. It's like, you know, like trendy stocks, weird stocks, whatever. Why? I can buy freaking Ford for $5. Why do I need to look at your dopey thing? You know, the Amazon's on a ridiculous sale. Disney's $85. What the heck? Why are you coming to me with Roku? I mean, come on. Who the fuck cares about Roku when I can buy Disney for $85? And we're using options because we don't have to. I'm not spending more money on Roku less money on Roku than I am on Disney. Freaking Qualcomm, Broadcom, Cisco, Intel, Microsoft, IBM. You know, it's like those are the stocks you need to be buying in a sell like this. First of all, because if everything collapses still, those guys have a way better chance of surviving than Roku does. But second of all, 20 years from now, they're still going to be gigantic companies. They're going to be bulletproof stocks in your portfolio. You're going to have an incredible portfolio full of great companies you bought cheaply. This is I would like to say it's a once in a lifetime thing, but apparently every 10 years we get these things now, where the market collapses and you get these chances. But that's fine, but you've got to take advantage of it. And you're not going to do it if you're wasting your freaking money on Roku. I don't know why Roku's stuck in my head, but you know, like Gilead and whatever. And again, that goes to the same thing. Somebody said Weyerhaeuser today, paper company. I'm like, why? Because people aren't using more toilet paper. They're just buying more toilet paper. They're shifting demand. Okay, if the coronavirus caused diarrhea, maybe I would say, yeah, you have a good premise in the toilet paper thing. But that's not what's happening. The coronavirus is causing people to be idiots, and they're buying a 6-month supply of toilet paper today. But that means that 6 months from now, they won't need toilet paper still. So all you're doing is shifting demand. Shifting demand is not increasing demand. It doesn't have a long-term benefit for the company. And there would be obviously no point in Weyerhaeuser putting more machines online. They're not going to put another $20 million toilet paper line into operation to supply the current idiocy, because you know what happens 6 months from now when everybody's got toilet paper, their basement filled with toilet paper, Weyerhaeuser is going to have 0 orders. And toilet paper is going to be marked down to 1/10 the price on the shelf because they can't even get rid of the stuff because everybody's got toilet paper and nobody wants it anymore. That's what happens in panics. That's why you short, you know, if it was a commodity, you short toilet paper now at the high price it is now, and you agree to fill the demand at a future period when people stop freaking out. That's how you play the commodity prices too. In fact, well, right now, for whatever reason, commodities are super low. Like, oh, look at gasoline. Remember our gasoline trade from last week? Very nice, right? 13. Well, that's today. From the open, $8,000 profit on gasoline. We also liked silver, I think, right? At $12. Holy shit. Silver's now up $23,000 from last week. We came in at 12 bucks, 12.50. And I think the other one was copper, right? I forgot what price we got in copper. Copper, $2, or a little over $2, and that's up $7,000 since we started. You know, so I mean, that's what you do. It's like you gotta put your foot down and say these are the right prices for things. It's not that hard. But again, if in the I'm saying in the this is a different situation. This is a situation where well, logically last week we were talking about this. I said, look, first of all, silver was stupid. It was down. Remember, silver was lower than gold, and that makes no sense. It should be kind of trending with gold. So silver had spiked down considerably. We jumped on that. Gasoline too, 50 cents. I said, you know, when you get to 50 cents, like, where are you going to go? How much lower can it possibly go? That's the trick. It's like I can only lose 50 cents, and you know, gasoline's not going to be free, but it could be $1 in the summer. So I have a lot more upside than downside. Therefore, I make the trade. When my upside is much higher than my downside, I make the trade. Not complicated. What else is there? Let's look at these other charts. Let's go on. Oil came back all the way to 23 today. That was, you know, but we were really buying 22.50, so we didn't hit that. Gasoline, natural gas is better than 162 where we like it, but we didn't catch that one. Here's gold, here's silver. Now silver's for some reason trending higher than gold, but that means when silver gets around 15, we want to dump those silver contracts now. Should have dumped it here. I don't know why I didn't. I guess I was sleeping. Yeah, it was I don't know, it was 8 o'clock last night. I would, if I was paying attention, I would have dumped it here because that was a good price. And right here's a good price too. It's not worth keeping and risking at this point because it's gotten a great run. And our indexes, look at the Dow go. Wow, 1,000 points up. That's 5% though. Now we're at the 5% rule, so it's going to probably have trouble getting past 21.8. The S&P is not there yet. NASDAQ's not there yet. Russell's not there yet. So it's really the Dow that's probably going to have a bit of trouble getting past 21.8 because that's the 5% rule there. Burns says U.S. cold is at 2617 as of this morning. I don't know what that means, cold. Greg says, hey, Phil, could you please talk a strategy for anyone like me who missed the boat on Monday to deploy sideline cash, $500,000 worth of cash? Wow. Well, I mean, Greg, you definitely want to talk about that in chat because it's like I can't do a whole thing now. But look at the stuff that we did for the long-term portfolio. We adjusted all these positions into, they're basically brand new positions in the long-term portfolio and the short-term portfolio, which we'll look at in a few minutes anyway. And the butterfly portfolio, we had a lot of adjustments in those portfolios that would be great for new positions. And you just want to pick a spread that still hasn't gotten away from you yet and take a look at some of those. But blue chip right now. You know, you don't want to go crazy. I mean, you really missed it though. Holy cow. You missed it a lot. You missed a big move, right? 10% market move so far, at least. 1020 says, what about the growing demand for bidets, bad for toilet paper? I agree. I have one of those Japanese toilets. They are freaking fantastic. You know, the kind that like shoot the water up your butt and whatever. It seems weird, but when I was in Japan, I got into them, and they are fantastic. I mean, you just really feel like the other kind of barbaric, like wiping yourself with toilet paper compared to like actually giving yourself a quick bath right after you go to the bathroom. It's just crazy. It seems like such a weird thing to do. So I highly recommend that, and it definitely saves. I don't know if it saves water. I don't know how much water it really costs, but it saves a lot of toilet paper. You still use toilet paper to dry yourself, but you're not jamming it around and whatever. But I highly recommend those. I'm telling you, and you can afford it. They used to be, when I bought my first one, it was like $2,500 or something like that when I bought my first one, like many years ago, like 20 years ago. But now they're like $500. You know, it's like, and they're perfectly good ones. And Greg says, deer in the headlights. Yeah. Yeah, that's the thing. I mean, especially like I said, like, look, you know, Greg, I really recommend going back though for future reference, at least go back and read all the stuff we were writing about last week, because this is what I was talking about. You know, we did a couple of things in the long-term portfolio, and in fact, I wrote whole articles about this. Let's see, we're done with this, so let's go top. So look, how did we handle this stuff? Oh, you know, I don't know if I made the headlines. Okay, so that was Friday. Thursday, stimulus fails to convince. Was it this one though? I'm trying to think of when I wrote my my picks for the long-term portfolio that we added. SQQ, wasn't those. That one's hedging, so I bet the day before is the day I picked the other ones. Oh, here you go. See, and you know, this is the point I'm saying. This is the bottom of our target range. Therefore, what do we do at the bottom of our target range? Look. So this is while we're going down, while the chart goes like this, I'm saying, I don't care. We went 20% up and now we're going to go 20% down. That's normal. This is our middle. You go 20% above, you go 20% below, and you settle down somewhere in between at some point. As long as we're not wrong about our value, as long as we actually, you know, knew what we were talking about when we declared that was the correct price. Since I'm very, very, very good at this stuff, I felt confident that I was right. So, but you have to go back 2 weeks and read all these articles, because you know, and again, I don't know. It's hard to say it without sounding like bragging, but it's like they were dead on. So I mean, you know, you read them and you see this is how you handle a crash. These are the moves you make. First you hedge, then you buy, right? We start breaking down, we start adding hedges. The hedges start paying off. Now we have some spare cash from our hedges, so we start buying, okay? Then but we don't buy, we sold puts. So first we sold a bunch of puts at this line because we thought maybe it'll hold and we'll bounce. It didn't hold. We said, okay, those puts got burned, but that's not a big deal. Then it comes down to here and we sell another round of puts, and this is another round of puts. So I said 28.50 is our must hold level. Below it, we're bearish. Then 20% below that is the bottom of our range. That's 22.80, and the S&P bottom of 23.50 yesterday. So we're not quite there. Blah blah blah. And again, you know, where are we? And again, what did I say? 22.80 would be the bottom of the range. We came a bit below that. But that doesn't make me think I'm wrong. That just makes me think this is wrong. More likely this is wrong than I'm wrong, especially because what was the reason we were down here? Because Congress didn't agree on the aid package, because they didn't give us the free money Monday morning. They weren't ready. They said this and that. I mean, it's like mommy and daddy are fighting. So what? You're still going to get ice cream. Yeah, that's basically the system. So, you know, I mean, here's me on the 17th telling you what's going to happen a week later. All right, I said 30, and it's the same bullshit I'm saying now. We were 40, you know, we're close to 40% on the top. Here's what we're going to do. We're going to hit 2280, blah blah blah. This is an incredible buying opportunity for people who have cash to spend. Our preferred way of bottom fishing is to sell puts. Why? Because selling puts puts more cash in our pocket. So here it is. Yeah. So last Thursday. Okay, so Thursday, the whatever the hell this was, the 13th of March. I said, here's 10 trade ideas. Now, what do the 10 trade ideas do? I just been on Money Talk, and I just added a couple to the Money Talk portfolio. And I said, down and down we go, and we still have plenty further to fall, but here's Boeing at 189. And yes, Boeing went way lower than that, but what did I say? We're going to sell the 2022 110 puts for $27.50. And that nets you in for, I don't know, 110 minus 30 is 80. So, 82.50 or whatever. So that nets you in for 82.50. I felt comfortable with Boeing at 189, promising to buy it for 82.50. Blue chip, buy it. Cisco, blue chip. What are we doing here? We're selling the 2022 25 puts. It's at freaking 37. We sold the $25 puts for 320. That nets us in for 21.80. Oh, it says that right there. Okay. Haynes, not a blue chip, but it's freaking Haynes underwear. It's like Maidenform, Haynes legs. That's Haynes. It's at 10. We sell the $8 puts for 220. Our net is 580. IBM, heard of them? Yes. Okay. The $80 puts for 10 nets you in for, why does that say 75? What the hell's wrong with my math? Nets you in for 70. We sold the 80 puts for 10, nets you in for 70 when it was at 117. Intel, notice the theme here, blue chip, blue chip, blue chip, blue chip. Intel, we sell 10 $30 puts. Intel was at freaking 50. I'm not taking crazy risks here. I'm selling incredibly cheap price blue chip stocks for prices I consider so outrageously low that I will take a freaking mortgage on my house and pay for the stock if it comes to that. I would rather have this stock than my house, for sure. If you're not going to take your money off the sidelines for this, when are you going to take your money off? Leibu, the biotech, and that one we took, and here we took we sold the $15 puts. It's at freaking 30. We sold the puts 50% below that price for $7.50. That nets us in for $7.50. How do you say no to that? And let's see. How far did they actually fall? Fell all the way to 12, but now it's back to 22. Plug Power, there's a speculative one. How'd Plug end up? PLUG. See, I had Plug Power. I had been dithering on whether or not to buy Plug or one of the other hybrid guys in our stock of the future portfolio, and I was so pissed off that I missed it because I was screwing around trying to. We had this portfolio, stocks of the future or something like that, we're calling it, and we only set it up like in January, and I meant to buy Plug, and then it took off on us because I hadn't really decided for sure if I was going to buy it was either Ballard Power or Plug, and I kept vacillating between the two. But then Plug took off, and I was like, oh my god, we missed it. So it came back here. There was no way I was going to miss it again. TD Bank did horrendously also, but again, what's our play on TD Bank? Another blue chip. In Canada, they're the bluest of blue chips. We sold the 25 puts there at 42, and we sold the 25 puts for 3, so you're netting in for 22. And what happened to TD Bank? Oh, 35, and then flies back up. You don't get multiple chances to get these prices. So yeah, it did go lower, but then it went flying back up because this is a stupid price already. I know it's a stupid price already. Tenet Healthcare. I do not even understand how hospitals could sell off in the middle of a healthcare crisis as putting people in the hospital. That seems idiotic. They went all the way to $10, and now they're back to 18. So they're back to where we were. But what was our play? We sold 10 of the 15 puts for $3.50, so we're netting in for $11.50. Viacom, another one that totally nosedove for no good reason. We sold the $15 puts for $4.50, so we're netting in for $10.50. And I bet we came real close on this one. VIAC. Yeah, look at that, right at 1050. It hit our net right on the nose. But then bam. My point was I'd be happy to own it for 1050 because eventually this was going to happen. I didn't know it was going to happen 2 days later, but eventually that's going to happen. But if I didn't take my chance to get in there, I wouldn't have gotten it. And remember, we didn't wait for this to happen. I waited for the opportunity to set that up. It got to 20. That was stupid enough, but the VIX was very high also. That gave us these huge put prices that allowed us to set up these ridiculously low net entries. All right, and that was round one. And what did we do at round one? We collected $43,350 in cash for selling the puts, and we have 27,500 of upside potential in Lebu. Oh, I'm sorry. So we have one spread. All of them were puts except for spread. And we used just 9,000. We used $10,000 in margin to set that up. So for 10,000 in margin, we collected 43,350 in cash. We have a 27,000 additional upside in Lebu. So basically, it's like $70,000 of upside potential if all of them come back on the money. And we did that before the market bottomed, and we knew it was before the market bottomed, but it didn't matter because we know what we're going to do to adjust it. And so then a week later, we were coming closer to the bottom. Now we're at 317. We still don't think we're at the bottom. And I'm still talking about it, but I'm telling you where the bottom's going to be. I'm saying it's going to be 2280. We're in panic mode now. Selling volume is overwhelming the buying interest, so we could go quite a bit lower. It's a great buying opportunity at some point. And then I said, well, what didn't we buy last time? We didn't buy Intel. And now, by the way, that other one was on Seeking Alpha. So those charts are frozen when you put them on Seeking Alpha, but these aren't frozen. So here you see what actually did happen. But remember, this is from the 17th. So basically in the middle of March, the IDs. So Intel 4460. So we did actually kind of nail that. So Intel is 4460, and it's the same thing. We sell the $30 put for $4 to net in for 26. That's way down here. And I'm saying we collect $4,000. We promise to buy Intel for 30. If it goes below 30, we buy it and we keep the 4,000. So our net cost is $26,000, 40% below the current price. It's never going to get there, so we're going to end up just keeping the $4,000. And this set we had about $80,000 that we collected. So in 2 weeks in the long-term portfolio, we sell $150,000 worth of puts. And they're so far out of the money that they're only using like $25,000, $30,000 in margin cost. And especially once the VIX calms down, those margin requirements go even lower. So we collect $150,000 for $25,000 in margin. And once the market normalizes, they're so far out of the money that we don't even have to consider them as an issue. We basically just have the free cash to put to work in our portfolio. And there's no emotion to this, and there's no real guessing to this. It's not a genius thing we're doing. We have a fair value estimate for the S&P. When the market goes 20% below the fair value, we sell puts that engineer 40% below fair value on blue chip companies that we don't see any reason that they're going to fail. So our worst case is buying blue chip stocks 40% below what we think the fair value should be. That's our worst case. Our best case is we get $150,000 for doing nothing. And in a $500,000 portfolio, that's 30%. Frankly, I mean that for normal people, that's as much money as you want to make in a portfolio in 2 years. And those are just our put sales. Apple is nowhere near cheap enough at 240. As I hear Foxconn, who makes iStuff, is testing all workers, blah, blah, blah. Still, any chance to buy Apple on sale is something we don't like to pass up. And we can sell 5 June 2022, 150. Way down here. We can sell the 150 puts for 1450. There are people so scared that they're willing to pay you 10% to promise to buy promise to buy Apple for 150 way down here. What's the bottom line? We collect $7,250 in exchange for $16.67 in margin. Now, had Apple kept going down, that margin would have gone up on us, so you have to really be committed to buying it. But when you have 500,000 bucks, you can afford it. That's the point. You don't have to pull the trigger. You're just promising to pull the trigger. You're saying if it gets that much cheaper, I'll buy it. Here's ADP. This is very simple. These are my one paragraph premises on companies. You would think people are never going back to work. I mean, it's freaking ADP. When I got my first job, I had to sign up for ADP. That's how you got paid. To this day, I pay my employees with ADP. I'm sure there's other payroll services, but there aren't too many. That's how it works. This is how you get paid. We're not laying everybody in America off permanently. So I said, I doubt the revenues will take a hit. It's being baked in. I find that what I find really attractive is you can sell, again, $80 puts. That's down here. For $12, that makes it down here. And you collect 12,000 bucks for 3,000 in margin. Why? Because I promised to buy ADP for net $68. It's at freaking, it must have been at 120 at the time. March 17th. So it was at 120 and I'm promising to buy it for 68 bucks. 43% below the current price. And I'm collecting $12,000 for making that promise against that. That's how you do nothing. That's what you do to be a deer in the headlights in your portfolio. This is your inaction. You say, well, at least I'll sell some puts. So my worst case scenario is if I completely miss the turnaround, I still get 150,000 bucks in my pocket. Amazon, what the F are people thinking? Now here we caught a really good bottom. Amazon is hiring 100,000 people. Have you not heard 100 different stories about how busy Amazon is, how they're so busy they're not even selling you stuff anymore? They're only selling things they think are important because they don't have time to deliver nonsense. And they are hiring 100,000 more people. That's a 50% increase in their workforce. Do you not think they're busy? Do you really think they're losing money this quarter? They're taking over the freaking world. That's what they're doing. So I said I would never pay $1,700. I said I would never pay $1,700 for the stock. It's still over 50 times what they earn, but I don't mind promising to buy them for $900. Okay, now I was saying way down here. 900 is like here. You have to go all the way to the next chart and halfway down that to get to 900. So I'm promising to buy it here, and it's up here, and I'm getting paid $23,000 to promise to buy it when it's down here. Why would you not do this? If you have cash on the sideline, this is your freaking job. And again, every single stock I'm mentioning, right? Did you know there were this many blue chips? Caterpillar, Clorox, Lockheed Martin, Medtronic. It's like these are huge, massive, permanent companies that are part of America or part of the world, really. I mean, they're not even local to America. So Caterpillar, same thing. We always buy Caterpillar when it's cheap, and Caterpillar got cheap. 95 it was at the time, and I said, well, wouldn't 45 be nicer? Sure, why not? Let's buy it for 45. So if I sell the 2022 $50 puts for $5, I get 5,000 bucks on 1,800 in margin. Yeah, why not? Clorox, bleach is killing the virus. Clorox is not doing well. I don't know why. Somehow Clorox went out of favor. But again, we promised to buy Clorox for $110 and get paid $750, so it's really $102.50. And we're selling these puts for 7,500 bucks. Lockheed Martin, I love Lockheed Martin. They're a stock of the century. I can't believe it finally went on sale. And I said I'd be happy if this one were assigned and if they expire, because I really would love to own it for this. We sold the 20, again, 160. This is 260. 160's, wait. This 260, where's 360? There, so it's gonna be that much there, right there. That's what we promised to buy. And somebody paid us $8,000 to do that against 2,400 in margin. And that margin, as we go up, is going to shrink. Medtronic, one we used to buy, but we stopped buying it because it got expensive. It came back to a ridiculously low price. We promised to buy it for $51. Notice every single one. I'm promising to buy them at ridiculously low prices. Square, I love Square, and that's one now. That's obviously not a blue chip. But Square is a very future stock. In fact, we put it in our Future is Now portfolio. Oh, that's what we call it, Future is Now. We put it in our Future is Now portfolio. And what did we promise to do? We promised to sell we sold the 2022 puts for $30. I'm sorry, 30 puts for $6. That nets us in for 24. Way down here. This is crazy. Why every single one? Why would you not do this? It doesn't make sense not to do it. It's like, what on earth are you doing? If you call yourself an investor, what are you investing in? If you're not willing to buy things at 50, 60% off their prices, when are you ever going to buy? You only buy things when they're expensive? Is that how you invest? And Exxon, of course, and Exxon we netted 2150, which is, you know, even though we were crazy low anyway, but 2150 is still down here. That just is, and that's just a line in the sand thing. I mean, again, we talked about this in chat, but that I said this is just an absurd price for Exxon. Because Exxon, you think of Exxon, they're an oil company, but the reality is they're also a refining company. Refiners' input cost is oil. You know, and gasoline's dropping, but gasoline ain't dropping to 55 cents. You know, when I go to the pump, it still says over $2 for gasoline, even though wholesale it's now 55 cents. That's not going to last anyway. And neither will super low oil. At some point, it'll come back, but you just have to be more patient than the idiots who are selling it. So here we collected $81,000 promising to buy stuff. That's how we do it. That's what you do in a crisis. So step one, hedge. Step two, start buying things, bottom fish. How do you bottom fish? You sell puts and you promise to buy things at ridiculously low prices. If the market goes lower, your hedges are going to pay off and give you cash that you can use to establish long-term positions in the stocks you promised to buy. When you establish those, if you start establishing the positions because everything went lower, you hedge again to protect the new positions you have. Hedge, buy, hedge, buy, hedge, buy. And when you start going back up, you take your hedges off. By the time you're buying the second round of hedges, your top hedges are already deep in the money. The first hedges you had are deep in the money. Then you put a stop on those so you can collect that money even though the stock market bounces. And that's why in the short-term portfolio, dividend, the short-term portfolio is now up 400%. We've got $500,000 now in the short-term portfolio. It used to be it was $100,000 portfolio because hedges all working off. We have $600,000 in cash. We have a negative value of these, but the trick for this is now what we have to do is work out of these positions without losing the $100,000. If we can do that, we're going to make another $100,000. We only started the long-term and short-term portfolio with $600,000 total, and now the short-term portfolio is worth $600,000. That's why the last short-term portfolio made so much money. Also, we had sell-offs like this. When all of your hedges pay off in the sell-offs, you make a lot of money. But now the long-term portfolio has bounced back. It was down considerably. Now it's only down 9%. 9% is not bad. 9% is $441,000. So now we have $900 and something thousand in what was originally a $600,000, $500,000 short long term and a $100,000 short term. So overall, we are now up $400,000 in the two portfolios. That's like 60%. And not only that, though, but we own a ton of ridiculous stocks in the long-term portfolio at crazy, crazy low prices. We have all the puts we were just talking about, and they are 25, 34, 40, 30, 38, 48, 50, 60, 73, 78, let's say 80, 85, 90, 105, and another 20, 125,000. So there's about $125,000-ish worth to collect here. That's not, it's already profit. There's $125,000 to collect if these things will expire worthless. And again, that's on a $500,000 portfolio, 400,000 now. That's a huge bump in the portfolio if the puts expire worthless. We have crazy low things, like we have Six Flags at 10. We have Plains Pipeline. It doesn't seem cheap. It's at 10.38. It's now 6, so it's going to take a while for that to come back. We have Amazon. Oh, we only have short puts on Amazon. Okay, we have $1,000, $900 short puts, but that's, you know, $23,000 we're going to collect on that. We have Broadcom. $200 calls on Broadcom. We have Berkshire. 170 calls. We have Cisco, $35 calls. We have Discover, $25 calls. We have Freeport, $5 calls. We have Gilead, $55 calls. GM, $18 calls. IMAX. Do you know if this market comes back, these things are going to double and more than double up in price? We're going to make another $500,000 on these positions if the market goes back to not even normal. That's the point, though. The reason we roll these positions down is to stay in a position so that when the market partially recovers, we're still going to make a lot of money. We don't need a full recovery because we kept rolling down. We reinvested in our positions. Why? How could we reinvest, though? Because we know our short-term portfolio's got the money. Our hedges are paying for the rolls. And I said that last week. I said, we're going to have to move some of this cash to the long-term portfolio if things don't improve. But you know what? They totally improved. We no longer need the cash. And this is what happened last cycle. In the last cycle, a couple of years ago, we had the same thing. We made a fortune in the short-term portfolio. But before we transferred any money, the long-term portfolio bounced back. We never needed the money. And so we just kept the money in the short-term portfolio. And then we ended up like doing, you know, we ended up having fun and gambling with it and stuff. But the long-term portfolio just went bip, bip, bip and made steady, normal amounts of money going up. This long-term portfolio will come out at $1 million plus the way it's set up right now if the market normalizes. You know, and like I said this morning, with $6 trillion being put into the market, I think it's going to normalize unless things are terrible for 3 or 4 months. That's probably not going to be the case. So let's see. So Greg says, need to develop self-confidence in what we're doing here. Thanks for, okay, all right, you're welcome. Anyway, so it's just practice. It's practice and seeing it happen over time. And the next time it happens, you're going to be like, man, believe me, it's not that easy. It's not like we've gone through it several times. I went through the crash of 2000. I went through the crash of 2008, and I went through the mini crash that we had a couple of years ago. And now we're going through this crash. I'm just like, it's another crash. You know, I'm an old man. I see these things all the time. So, I mean, that's part of it. It's just getting used to it. But you have to study and read, and that's why I was pointing out that article, well, we erased it now. The article we were talking about in last week's webinar, that I was saying this is how we handled the previous crash. You have to look back. The reason I started keeping a stock log was so that you could look back and say, what did I do then? What did I do last time the market crashed like this? What were the trades? In fact, that's what we were looking at last week. We were saying, well, what worked really well last time? Because that's what you want to play. Say, what was great? What was successful? I said, oh, I forgot about that ultra financial that we shorted. That was fantastic. You got to think about what worked last time and will it work this time? Robin says, Phil, do you feel another drop will occur and another chance to get in will occur? Look, first of all, things are still ridiculously cheap, and you can still sell a lot of really good puts and calls. We only just, 2 days ago, we were just selling stuff. I know the market's up a lot right now. I wouldn't go chasing things too high, but you can make some small plays, and you could, things that you're going to things you'll be happy to double down on if the market does fall back to where it was. And what you want to do is look at the puts and look at the calls and say, what didn't move that much from Friday? What's still in play? Not everything moved up. You got to look at the ones that are still lagging and think about those for plays. Also, there's still bull call spreads. A lot of bull call spreads are still very cheap. So in other words, instead of selling the puts, you just take a bull call spread. Like, for example, let's take a look at Viacom, because I know they're still pretty cheap. I think Viacom is 15 bucks. I think Viacom's ridiculously cheap. All right. So you're not going to get a really great price for the puts anymore. You're only going to get $2.50 for the 10s. It's still good, but it's not fantastic. I would sell the 13s for close to 4, and that's net 9. That's still a pretty good sale, but you don't have to, or I would just sell a few just out of principle. But the real cheap thing that you can still do, though, is you can buy the 13 calls for 6, and you can sell the 2250 calls for 3. 260, 325, figure close to 3. So that's net 3 on the 13 2250 spread. So that's a $9.50 spread, which is a weird number, but it's a $9.50 spread, and you're buying it for just about $3 per spread. So you've got a 200% upside if Viacom goes to 2250. 200% upside, irregardless of the puts. So you can take that spread and just be very happy with it and not even sell the puts, because 200% upside in 2 years is a lot. And Viacom is see, we're talking 2250. That's your target in 2 years. To get back to 2250, you make 200% with no margin requirement whatsoever. There's a lot like that, and that's what you want to do. You want to go through that whole list that I just showed you, which were like I said, in the last 2 Thursdays, they were right in the, they were, that was our morning report for the last 2 Thursdays, was all these different stocks to buy that you can do. All those blue chip stocks, instead of selling puts if they're not cheap enough, you can now look at the bull call spreads, and you generally want to be slightly in the money and try to sell as much premium as possible. You look for things that have heavy premiums so that you get a decent entry. You want to make something like 150 to 200% on the upside, but look for it where it only has to go up, maybe recapture like a third of where it was. So in other words, this fell from 40 to 15. So that's got 30 bucks to go back up, basically. So you look for something that's going to peak out at 25. Because 25, 35, 45, that's fully recovered. This only requires it to go 1/3 of the way back in 2 years. That's not asking a lot. That's not a lot of pressure on your stock, unless it really sucks. That's going to be okay. And of course, you obviously want to pick one, but I already did. I already gave you 20 stocks just now. We just went over them. 20 stocks that I feel should recover, that I feel are not going to suffer severe damage because of the virus. Viacom, to me, is completely obvious. It's freaking CBS. What on earth is going to happen to see? Why would they be doing worse? I think they're going to be doing better. Everybody's sitting at home watching TV. It's MTV, it's CBS, it's Nickelodeon, it's Comedy Central. What the hell is wrong with them? I think this is completely irrational. So same thing, except now you'd be looking at like a bull call spread where you don't have to worry about the margin. And if it falls, if we fall, then you sell some puts, then you can roll it to a lower strike and put some more money to work in it. But right now, just take I mean, for God's sake, if it's going to make 200%, and you have let's say you have a $500,000 portfolio, like I'm sorry, I forgot your name, but the guy has $500,000 to invest. So if it's going to make 200% in 2 years, if it goes well, you just take 100,000 of your money, 20% of your money, and you put it into those stocks. They're going to make $200,000. You're going to make 40% back in 2 years if those things recover. If they don't recover and the market goes lower, he's still got $400,000 sitting on the sidelines to start putting in some serious bids at a lower price. That's virtually no risk. And like I said, I'm under that. That's the premise under which I'm putting my kids' college fund money back to work. I'm putting their money back because if we go up, they're going to get an extra 2 years of college. They'll be able to go to grad school out of their college funds. And if we don't go up, so in other words, if they go up and they make 100%, they'll be able to pay for grad school for 2 years. I'm only going to use half of the money that we have for their college. If it goes down, so let's say I put 150,000 in, instead of it'll go down to 75,000, but now I still got 150 on the side. The 150 on the side, if I then deploy that, I'm going to be able to buy twice as much stock as I have at the much lower prices. So then I've got 3 times the stock at a 50% discount to where it is now. And so basically, if frankly, in 4 years, if the world hasn't recovered, then it really doesn't matter whether or not they go to college. So it's okay to lose their college fund if that's the case. But assuming the world is still here and they graduate and there's a world to go to, they're going to have an extra $300,000 for grad school. So the risk justifies the reward, justifies the risk. That's the key to these things. But that also depends too, because for me, I'm like, well, if I have to, if for some reason if some reason something really weird happens and they do lose money, I would just basically have to borrow money for college, but I know I can do that. So my worst case scenario is not they don't go to college at all. The worst case scenario is I have to now go into debt for their stupid college that I thought I already paid for. But my best case scenario is they're going to have hundreds of thousands of extra dollars after college. So I'm willing to play for that. It's a worthwhile reward to work for. And obviously, fortunately, I did pull their money out of I did cash in their college funds before all this bullshit happened, because I avoided taking losses, and those college funds were already adequate to pay for their colleges. SunPower, views on this in terms of market and revenue profit going forward. SunPower, I like SunPower. SunPower makes the most efficient solar cells, the best solar cells, the highest quality solar cells. There is a market for that. Just like there's a market for Porsches, there's a market for the best solar cells, and not because of the bling, but because in certain situations, like if you have limited space and so on and so forth, the efficiency is more important than the cost. Okay. If you're in the city, for example, and you don't have a lot of roof space, like if you're in the middle of a suburban place and you've got a giant, and you've got a business and you've got an office park and you've got huge roofs and spread out campuses and things like that, you can go with inefficient solar cells because you have a very wide area to deploy them. So you can go cheap and inefficient. But if you only have 1,000 square feet of roof in the middle of Manhattan, you need to get the most efficient solar cells possible. Okay, so SunPower is the right tool for certain jobs, and they're not the most. And this is also where people get confused. SunPower is not the most expensive solar cells, as in other people have it cheaper. Just like Porsche is not the most expensive car compared to other cars that are like Porsches. No, it's a car that's better than every other car or most other cars, and it's engineered that way, it's made that way, and not many people are going to tell you it's not a good car. It's totally good, and it's actually a fair price for the money, but it's more money than a Lexus, because they use better stuff, because it does this and that, because it's a little bit better at this, it's a little better than that. And for some people that matters, and those people can afford to pay for it. That's what SunPower is. So it's a viable market. They have a niche. I like their niche. They are extremely good at developing better and better stuff. Down the road, the prices do come down, and they get plenty and plenty of contracts. So I like them for the long term. And also, don't forget, they are a chip company like Intel. Intel doesn't have the cheapest chips. They just have the best chips. But there is a big market for the best chips. AMD sometimes is in favor, sometimes is out of favor. They have cheaper chips. They rarely have the best chips. So I like SunPower. I've always liked the way they market and the way they do their stuff. Micron, also another good company. What's your view on them? How will they acme in? What does that mean? And how to play them? I have a 60 price target, not them. Wow, very confusing sentence structure. Micron, MU. Again, I'm not a chaser, but I would do the similar thing. I would look for a bull call spread that makes sense. I'll show you on Micron because I like them. MU. So we say Micron is at $44. So let's just, for example, let's say 40s are, very wide spreads. I don't like that. 1385, 1525. All right, so let's say it's going to cost you $14.50 to $15 for the 40s, and you can sell the 55s for almost $9. So what do we say here? $14.50? Yeah, so if you can get $14.50 and $9, that's $5.50, and it's a $15 spread. So again, it goes back to that rule of thumb, right? So if you can pay $5.50 for a $15 spread, that's $5 in the money, you're paying basically no premium, and you have almost 200% upside. So if you want to play them, that's the way you play them. You don't want to sell the puts. You can sell the puts. I mean, they're not bad prices. You can sell the $35 puts and feel pretty comfortable about that, especially when you're getting $8 for them. But I would only sell a few. I would sell like 1/3, because if they go lower, you're going to want to sell puts for a better price, or maybe double down on these at a better price, because we don't know that the market's going to keep going up. We don't know that the stimulus is going to be enough. We don't know the virus is going to stop. We don't know a lot of things. So I wouldn't overcommit that way. But what you say to yourself is, say, I would take just the bull call spread, the 40-55 spread, and then if Micron goes down again, if it goes up, you make 200%. So shut up. That's fine. If it doesn't go up, that's when you're in luck. Because let's say it falls $10 again. Then what happens is then you sell the 25 puts, which are now $5 or less. You sell those for $8 or whatever. Well, wait, what do we? Oh no, I'm sorry. You sell the 30. Wait. You sell them for the 35 puts, right? You sell those for like $8 if it drops. Then you take that $8 and you roll your 40 puts down to the 30 puts. Well, not the 30 puts, it would be lower, probably the 25 puts. You probably get to roll them down $15. Then you would have a huge wide spread on Micron. You'd have the 25 short puts. You feel really great about that. And then you wait patiently 2 years for it to come back. Then you can make 300%, 400% on the same position. But for now, be happy to make 200%. If it gets away from you and goes up, you can go, boo-hoo, I only made 200%. But that's the way you got to look at that stuff. There's no reason you don't want to be overcommitted to things if you don't have to be. You really have to just, we don't know for sure that this is going to fix everything. And you want to just make sure you're flexible and that you're ready to take advantage of the next downturn if there is. If there's not a next downturn, okay, we'll make 200% and be bored. I don't see that as a real big negative, though. Mark says, what about the lack of advertising on networks? I'm sure not seeing that. Are you seeing that? I see plenty of ads. I see the same annoying amount of ads I always saw. They might be getting less money for them, but again, I don't see how that makes sense. What is, is this based on something that you actually know? Because I was always taught that there's a supply and demand of these things, and that obviously, if more and more people are home watching TV 24 hours a day because they got nothing else to do, then wouldn't that create a larger demand for advertising? Would that not be more eyeballs being hit and more money for ads and so on and so forth? Now there could be a transition period, let's say, because the people who were advertising, like the Olympics, for example, or like sports, which is off, or like movies, which are not being seen, a lot of advertisers may be dropping off, but they will be replaced by other advertisers who are in the new economy, like the mask sellers and things like that. Well, that'll be funny. You replace the mask singer with the mask seller. You have people come out in different surgical masks, and you can vote for them. But you know, I mean, we're a very adaptive society, and you know, the cool thing about American capitalism is we fill all the niches. So I imagine that there'll be a lull in advertising, but then things will come back just because you're having a change in the guard on who's there. So Mark says no new productions and no new work. I'm seeing brand new commercials though. Somebody's making commercials. Maybe your place isn't, but somebody's making commercials because there's commercials about the COVID. In fact, I'm looking on MTV, right? Not MTV, CNBC. You know, and oh, it's not CNBC, it's Bloomberg. But they just had a CVS commercial where they were talking about whatever products that people need. And again, I don't know, you know, I don't know what the prices are going to be. I don't know what people are charging and such, but I think it will more or less normalize at a certain point. But maybe, you know, maybe at a slower pace, but I still think that there's plenty of money that's going to be made by these networks. And by the way, no new productions means they're not spending money on productions. And in fact, it's going to be great for Netflix because Netflix was spending obscene amounts of money on producing content. And it should be good for them to have a break. Any trade suggestions on Apple for 2021? Well, that's very specific. It has to be 2021. Apple, wow, they really shot up. They're back to 255 already. I don't do 20. I wouldn't do 2021 because you're just not selling enough premium. You're not giving them enough time to come back. In fact, we're going to June of 2022 with our plays, and what we like is you know, you want to sell as much premium as possible. So like the premium on the 260s, it's all premium, obviously, it's out of the money. So the premium, it's about 48 bucks, 48.50, let's say. So then you say, well, how far down can I go? How much am I willing to spend on the spread? Let's say you're willing to spend 50 bucks. So that means basically right about here. Wait, can't see what that is. So this is about 100 bucks. And this is the 170s. So you can take the 170, 260 spread. Now, you know, that's 80 bucks in the money. And it's going to cost you the 170 is going to be 100 minus the 270s of 45. So let's say it costs you right about $55 for the $100 spread. And then, like I said, though, that's 100% upside. And all Apple has to do is stay where it is right now. You can do that, and you could also sell if you want to offset the cost a little bit. You can sell with 230 puts, so you can sell, which are 40 bucks, let's say, or you can sell the, what are these? The 180 puts for 20 bucks. But again, I would probably wait. I'd be happy with my 100% upside on Apple at 260. Or what did I say? 270? 270. So if I have my 100% upside, if I have almost 100% upside on Apple at 270, sorry, I'm almost certain I'm going to make that money. I mean, you know, I mean, it's all the way in June 2022, but all Apple has to do is not fail where it is now. And if it does go lower, that's when I'm going to want to sell a put. So let's say Apple drops, let's say with 10%, I wouldn't even do anything. So let's say it drops 20% and it drops 50 bucks. That means that the 180 calls will be the price of the the puts will be the price of the 230. So it'll be 40 bucks. So then I would sell the 180 puts for 40 bucks. So Apple drops 50 bucks to 200. I would then want to sell the 180 puts for 40 bucks. And then I would take that 40 bucks and I would roll my 170s to, which is 140, or you can roll them all the way down to the 115s, or at least the 120s. So I could literally take that money and roll down at least $50 in strike, and probably more because obviously everything would be $50 cheaper. But so I could roll down at least $70. I could roll down at least $50 in strike, probably $60, $70 in strike. then you would have a almost $150 spread. You would not have spent any extra money on it. You would spend $50, and now you're back to what would be the 200% upside. And again, all Apple has to do is get back to 260, and you're set. That's the kind of trade I like to be in. So in other words, if you just buy the bull call spread, you make 100%. If Apple goes up, you make 100%, and that's it. If Apple goes down, however, you get the chance to sell puts, use the put money to roll your calls to a lower strike, and then you'll make 300. Then you'll make 200% or more on the same trade if it gets back to 260. So you almost kind of want it to go down before it goes up, because you'll make more money if it actually does poorly at some point. But meanwhile, if it goes up, your consolation price is you're going to double your money. Nothing wrong with that. And that's the thing. And you don't want to overexpose yourself. So it's not really worth it. And it's not just that Apple is higher, it's that the VIX is much lower now than it was last week. Where's the VIX? And by the way, that was like a major trigger for us to start doing these sales. All these put sales were because the VIX was crazy. Right? When did we start doing the put sales? On March 13th and March like 20th or 18th or whatever. These were the days when we started doing these put sales. And why did we do it? Because the VIX was at this crazy high price that we know is extremely unusual. How unusual? This unusual. It was up here at 70 very briefly in 2008, 2009, and now it's up here again. So we had one time in the last 10 years that we were able to sell puts for such ridiculous prices. And like I said, look at the long-term portfolio. It's a short-term portfolio. Look at the long-term portfolio. Where we get there? There it is. See the fluctuations? Now it's down 13. Already, we just took these 12, 23, 24, 13, 12, 12. Most of these are like 2 weeks old or less, and they're up 12, 20, 18, 69, 20, 69. Oh, that's much older. I was like, that seems like a lot. Energy transfer, nasty. Anyway, so 40%. I mean, from 317, the Caterpillar's up 40% already. It's not so much the Caterpillar went up in price. It didn't go up that much. It's that the VIX collapsed, and therefore the premium of the option collapses. We sold that premium. That's what it is when you sell a put. You're selling premium. So we sold that premium, and the premium collapsed, and that screws the person who paid us for it. So we could buy some of these back now if we wanted to, but we're not really tight on margin, or we don't really have any problems right now. And we're certainly not worried about any of these positions. But if we wanted to raise some quick cash, we could cash these out for 3, 11, 13, 15, about $20,000 in profit already. Remember, we sold $150,000 worth of puts. They're already up $20,000 in like not even 2 weeks. And why is that? Not because the positions changed that much. It's because, and obviously not because the time is expiring, so it didn't have any time to move. But what happened is the premium in the VIX collapsed, and that's what made us some money. And that's why, though, we knew. So you say, how did you know to jump on it? We knew to jump on it because this happened. Once that VIX went over 50, we said, that's a good opportunity. And then understanding options, we say, well, how do you take advantage of the VIX being over 50? Well, you sell premium. How do we sell premium? Let's promise to buy things really cheaply. Let's promise to buy things by selling puts. And that way we'll sell a lot of premium. What else do? We roll our positions. We sell the position we have, which is out of the money. So in other words, we have a call that's out of the money or near the money or whatever. that call has a lot of premium. So we sell it. We then roll it to a lower strike. And what are we doing? We're buying a call that's deeper in the money that has less premium. So we're trading a lot of premium for a little premium. Again, to our advantage, right? And on the put side, if we already have short puts, we take a single short put that's deep in the money and doesn't have much premium left, and we roll it into two short puts at a lowest strike that's mostly premium. So again, we sold a lot of premium, and that's what we did on, does anyone know what day that was? What's this? Oh, look, see, Marriott Vacation. There's a good one. That was from when? That was Monday. Oh, that was smart. Yes, that was a good call. Okay, anyway, Roku. Oh yeah, that's see, I was complaining somebody's told me about Roku. Here we go. So what are we doing? Here's Apple. And I said, so here's our Apple position in the butterfly portfolio. And I said, Apple has June 2022s and the 200 puts at 43. So we can roll our loss. What loss? 200 puts. Why is this? Oh, I see. So we have the short puts on Apple, and I was saying we could roll our loss. I guess the loss had gone up at the time. So we're rolling our loss on 20 of the 260 puts to 25 of the June, further out in time, of the June 200 puts. So we didn't roll the entire amount of money. We rolled the loss because we already collected this money. So effectively, we've rolled this and it's net zero. We only rolled the loss and a little bit of change. So but in other words, if these expire worthless, if Apple's over 200 in June 2022, what happens is we just don't lose any money. But you know what? Erasing $122,000 loss or erasing $107,000 of a loss is just as good as making $100,000 because the loss is already baked in. The loss is already there. And then I said we roll out our 2022240s, which are these. We have the 240 calls to the June 2022200. So again, we're selling the premium of the 240s because Apple was at 246 at the time. So this was all premium. And we rolled it to the 200s, which were 60,000 more, but those were 40 bucks in the money. So they're 80,000 in the money. So we have less premium in the lower position. We roll the short 310 calls to the June calls that have double the premium. $57,000 of premium, all out of the money. We roll it to ones that are $111,000 of premium. This is what we do when the VIX is high. We sell all the premium we possibly can. Every move we make in the portfolio on Apple, on Disney, on Mondelez, on the marijuana ETF, on Whirlpool, X we didn't change. We already changed because we already changed it like a week before. Every single position here, we've meant more premium, more premium, more premium, more premium. Those are all the adjustments we made was to sell a lot more premium, and this was on Monday as the market was completely collapsing. Because if you're not going to sell premium when the premium is at a ridiculous high, what the hell business are you in? I mean, that's the point, and this is why, this is why it's very important to me and why it's very important to Phil Stockwell. The point is to teach you, not just to teach you, here's a trade, which they say is giving a man a fish. If you give a man a fish, you feed him for a day kind of thing. But it's the important point is understanding why we're doing these things. Because if you understand that selling premium is really our ultimate goal, that's what the whole concept of being the house is about, is sell the premium. And if you understand that that's how we make all our money, then when you see the market collapsing and the premiums going through the roof, you say, oh my God, what a great time to make money. And we did, because look at the butterfly portfolio. Well, and again, understand, because the butterfly portfolio is all about selling premium. So we got screwed when the VIX was that high. But the butterfly portfolio now, I think, is completely turned around. So that's all it takes is for the premium to drop. Yeah, now it's up 72%. Okay, because all this inflated premium drained out of it, and we moved to positions where we sold a lot more premium. It was we did exactly the right thing, exactly on the right day. And that's how you turn things around, though. And the long-term portfolio didn't turn around quite as much, but it's going to. These positions are astounding. I mean, you look at these freaking things. We have Exxon at $30. We have Exxon at $30. We have Walgreens at 40. I see. We have Walgreens at $40. We have Viacom, like I said, at $5. I mean, these are crazy prices, and they have so much room to run. So the butterfly portfolio is designed differently. It makes money based on the premium sold, and when the premium spiked up, we just sold a huge amount of it, and now the premium prices came down, and now we made a lot of money. Or really, we went back to where we were before all the madness started, pretty much on the butterfly. The long-term portfolio is not designed the same way. The long-term portfolio needs price appreciation. We're still really low, so you're not seeing it yet, but this portfolio now has the potential to be well over $1 million. If these stocks go back to where they were, and not back to where they were, they only have to go back to, Exxon. We sold the we sold $60 calls. In Walgreens, we sold the $55 calls. So Walgreens only has to go back to 55. And Viacom only has to go back to 15. Vail doesn't have a cover. Textron has the 1750 calls. That seems laughable. They're $10 in the money now. And if it goes back to 45, we're going to make a freaking fortune. And I mean, you can see how much you're going to make. That's 1750 to 45, which is, let's say it's $25 times 25 is, I don't know, it's like 50,000 more. It's more than $50,000 spread, $60,000 spread, and the net of the spread is 29 minus 18, so about 10,000. So this is, and by the way, somebody's asking me what's a good spread. This is a $10,000 net spread that's going to pay $60,000 if it gets back to 45. Textron. That's what I'm saying. You only have to go to these portfolios, and you can see all kinds of things that are going to make a fortune. Textron needs to get back to 45. If it gets back to normal in 2 years, that $10,000 is going to become $60,000. And that's what the long-term portfolio is now full of. Except we've got, notice how the security value is there. So we've got $400,000 worth of positions that are going to triple if they just kind of claw back to where they were roughly. And even if they just double, we're going to make ourselves, well, we're going to have $1 million. We're going to double our portfolio, plus whatever we have in the short-term portfolio, which is already $500,000 or whatever. So it's all about balance, but it's about balance. And again, the whole point of this being the house strategy is to sell premium. And when you get into a situation where somebody is willing to pay you more than double the usual price for premium, this is the usual price for premium, 20. We're being paid 50, 60, 70 for premium. How much can I sell? This is a time to sell as much premium as you possibly can. It's obvious. And if it comes back down to 20 or even below 30, I think we're going to have to probably consider, because right now it's at like 50. If it comes back to 30 and we're going to be up, let's say that we're quickly on these short puts. Let's say we're quickly up 40% or 50% on these short puts. Well, shouldn't we take them off the table? Why would we keep risking it? The market could always collapse. Something bad could always happen. So, at a certain point, you have to be realistic and say, wow, we made that money really fast and we have to wait all the way until 2022 to collect the other 50%. So maybe take it off the table and maybe there'll be another chance to sell some more premium. Now, of course, some of these, I mean, they're ridiculous. It's like, I don't think Tenet Healthcare is going to be below 15. I don't think Mountain, which is Vail Ski Resorts, is going to be below 100. I don't think McDermott's going to be below 60. I don't think Lockheed's going to be below 160, 50% off the current price. Intel, again, these are such stupid low prices that it's kind of hard to say I want to take them off the table. But if you're up 50% and you got 2 years left to go, maybe it's not worth it. Maybe we could find something else to sell. That's what you have to decide. It's like, could I make better use of the margin? Could I make better use of the slot that I have? But the thing is also that the margin decreases rapidly as you get further and further away from the money. This is, Boeing has to drop more than 50% for this put to even be at the money. So the margin requirement for us to wait for this $14,000 is very low. We may be using up a couple of thousand in margin to wait for this $14,000 to pay off. I don't have a more efficient thing to do with $2,000 worth of margin than make $14,000 if Boeing stays above 75. I don't have a more sure thing that makes more money for less of a commitment than that. And that's what you always have to do. You have to go over every position you have and think about the utility value of that position, and can your money be put to work in a better place, or is this the best, safest, most efficient use of your money? That's what, that's all part of balancing your portfolios, making sure your money is working for you in an efficient manner, making sure it's just like running a company, really. All these positions are like your employee, and they've got to be doing their jobs. And if they're not doing their jobs, you got to fire them. You got to get better positions. And that's why we always do these monthly reviews. We look at every single position every time, and sometimes we fire our positions and we get new positions that are better. Your portfolio is supposed to work for you. It should always be full of the best possible positions. So keep that in mind, and definitely review the entire month of March. If you guys are bored, read all our posts and read all our comments for the month of March, and look at what we did when the market collapsed. Look at what we said, look at what we were watching, and look at when we acted. Because again, like sorry, like whoever said, was it Greg? I think it was Greg. So like Greg said earlier, it's, you have to know what to do. You have to be ready to act, and you're only going to be ready to act by practicing and going through it and drilling, just like anything else. They'll teach a fireman that if the hallway's on fire and the exit is over there, that you can't sit there and think about it and whatever. You have to run through the fire and get out the other side, because it's going to get engulfed and it's going to get worse. It's not going to get better. And you have to train for that, and you have to practice. And when it happens, you have to be ready to act. And investing is not that different. You've got to train, you've got to practice, you've got to be ready to act. And to do that, you've got to read past experiences, you've got to have some experiences, but you've got to learn from them, and you've got to take notes and write them down and say, this is what I need to do. You've got to be ready, willing, and able to take action. And you've got to make sure you're ready for it all the time, because you never know when crazy stuff like this is going to happen. And that is a good place to wrap it up, I think. So everybody have yourselves a lovely week. We will do this again next week, and hopefully we'll continue on this uptrend, and we'll have some exciting news. I mean, I will see this long-term portfolio. I'm so happy with that positioning now. It's like I just can't wait to see what happens. Let's see if there's any last questions. Any suggestion on Apple? We just did that one. Why do you do vertical spread instead of diagonals? Calendar spreads, less maintenance. Yeah, the vertical is just simpler. It's like I really, I mean, frankly, it's like you can make so much money doing a vertical, and you have less risk when the market goes up and down. So if you like your target, and when your targets are this freaking easy, I don't see the reason to do anything too fancy. I think the easiest thing is to set up a nice vertical. All right. Thank you, everybody. Appreciate it. And we will do it again next week. All right. Take care, folks.